Welcome to LPA, Logical Price Action, the complete course, Session 1, Structure. Now before we begin, please take a read through the disclaimer and the copyright. Again, please don't share via file sharing websites, torrents, etc. So, today's agenda. First of all, structure. What is structure? Well, it frames price. It contains the price action. Okay, this comes in the forms of bars, candlesticks, Renko, point and figure, etc. Okay, so when we talk about structure in this sense, it's the application of structure, not to be confused with market structure as in terms of price, i.e. price, bouncing up and down within a trading range. Some that can be considered structure, as in the trading range itself, along with accumulation or distribution, are forms of market structure. Okay, although these concepts are important to recognize, we consider them to be more or mere background conditions. Here we will discuss the practical application of structure, the physical lines on the chart. This will include the correct use, the incorrect use of, and advanced subtleties. Now, structure in this sense, within our methodology, is incredibly powerful. It's one of the oldest chartist techniques and often overlooked due to its simplicity, yet when applied correctly, with the ability to interpret what the market is saying, what's it whispering in your ear, it can offer a great deal of data, giving us that infamous edge. Okay, now within this methodology, and as I stated in the introduction, volume and price are imperative. They're extremely important. Okay, but structure, how can I put it? Structure is a close third. It's a trifecta, and we need to use structure correctly. Now, most traders, unfortunately, will underestimate the importance of structure. However, to the diligent and adept trader, it offers a unique tool, and a genuine skill is obtained once accomplished. I like to use the word skill. It's used purposely, as like most things in life, it requires practice to become competent. And there lies the key. With structure, along with most things within trading, you need to practice, and practice some more. Today's session will provide the necessary information for you to truly master the use of structure and ultimately become a skilled practitioner for yourself. Of course, this will take time, but well worth the effort, as it will offer additional insights that most traders do not possess. Now, structure is not limited to the trading principles found within the rest of our sessions. Its application is universal. Okay, if used correctly, it can offer an edge regardless of methodology, and this is the main reason why I've decided to use structure as our introduction. This is why it's our starting point. Now, although simplistic in nature, it is a fundamental concept that must be used correctly. We need to understand its importance and iron out any unfavorable habits that may have occurred or already may be used into your current trading behavior. These bad habits must be eliminated before we move on. It's of the utmost importance. So why the importance? Why use structure? Well, it gives a roadmap for price. It's the very framework of the market. I like to think of it as the bare foundations of a house. Now, imagine a house with no plasterboard, no carpets or wiring, cupboards or anything of the like, way before, stripped right back. Like how cement is constructed into a pillar, it's usually poured into a metal girder, which of course is the framework. All the cement oozes and adheres to the very fabric of the structure, which is very similar to price, volume, and the lines on a chart, which we call structure. Okay, they price and volume is kind of cemented and held together by structure. Price, more or less 80 or good 90+% of the time, adheres to structure. And structure comes in the forms of trading ranges, trend channels, and some patterns like an apex or whatever. We're not really pattern traders. Now, what can structure do for us? So what are the main uses of structure? You may be asking yourselves. Well, it can give direction. Literally by constructing a trend channel, a simple trend line, either a supply or demand line, we more often than not can determine the direction of the trend as we make high highs and high lows, or lower highs and lower lows within the channel itself. Let me just quickly draw this for you. So this is a trend channel, okay? And if price is adhered within the trend channel, we can see we're making higher highs and lower lows. So this gives us direction. Odds favour now we come back down here and price would what? Go higher. So it gives us our direction. Okay. It can also help with market sentiment for strength or weakness. So let's do another illustration here. If we break through 3 or 4 levels of support, so price comes down, we're smashing through, and we're just continually coming down, and we break support decisively, we know that the market is incredibly weak, and we would want to avoid at all costs taking any potential long positions. And it gives us the possibilities to look for short plays, so we can use this mindset or this slight bias until the market tells us otherwise. So even if we came into the market and we did our pre-market analysis and we thought the market would go up, okay, and we can see, say the market opens here and we can see price coming down, smashing down, and by 3 levels of support, okay, and we can see that price and volume, the price action is weak as we're breaking through these areas of support, okay, we know, the sentiment is weak. We do not want to look for long positions, okay, so this keeps us safe. And we can also determine whether the market is in a potential overbought or oversold condition. If we're in a position, we may want to take partial profits, liquidate entirely, or by gauging the severity of the overbought or oversold condition, the analysis could alert us to the market offering us more than a mere pullback or correction. We may have a potential reversal scenario. Of course, this is extremely important data. Now, we will be studying trend channels in depth, but just to highlight or illustrate what I mean is when we come down, so this is price moving up in an up channel, down, up. When we come to the supply line and we break it or we're near, this would be a overbought condition because we're buying, okay? And if we're coming down in a trend channel, price hits the supply line, this is the demand line, supply line, demand line, and we break a little here because this price adheres to this demand line, okay? If we hit here and we penetrate a little, this is considered to be oversold, okay? Don't worry, we will be going through this in depth. Importantly, we can use structure to lean against for many of our trade setups. They're excellent for entry locations. Why? It reduces risk as we are right at the danger point. Also, structure provides way in advance potential exit locations. It gives target areas, so we have a one-up. We are ahead of the game in this scenario, especially if we have a working, validated channel with multiple touches. Don't worry, we will be going through this in its entirety in this session, Okay, so hopefully it's becoming apparent that there is a great deal of information or data that we can gather alone from reading and interpreting structure. It truly is powerful. Its applications are boundless. It can be used on any time frame, intraday, swing, position trading, and in any markets. Futures, indices, stocks, forex, ETFs, commodities. So various instruments using various time frames will be used throughout these sessions to highlight its practicality. I have to admit, I haven't tried all time frames on all markets, but I've yet to find one where structure has had no useful role to play. So that being our little introduction of structure and what structure is, let's go through today's agenda. And structure, as you can see on the screen, we will be going through support and resistance, axis lines, trend channels, confluences, personal favorite, you will see why. A little on, we don't do patterns with this methodology. However, there is one, an apex, which we will be going through. And lastly, an amalgamation study containing all structural components above. Now, within each of these categories, there will be individual studies. Again, please feel free to ask questions, but at the end of each individual study, I will go through the questions. So let's begin. Support and resistance, the most famous of all structure, and that I'm sure most of you are familiar with. Now, support and resistance is horizontally drawn. Support is from the lows, resistance from the highs. Okay, there is a phenomenon where support turns into resistance once broken, and resistance turns into support also when broken. Well, what do I mean by this? Let's go through this quickly. So it's horizontally drawn. Okay. And if price is bouncing between here, okay, this would be support, and this would be resistance. Excuse my writing, I'm using a mouse. Okay, resistance, we get the picture. And so when we come back down to support, we'd expect demand to come in and we'd rally back up to resistance. Now, if price travels through resistance and comes back down, we would expect this area to hold, I've circled here, as resistance would turn into support. So this would now be support. Alternatively, if we come back down here, we rally through, we break through, we come back, we'd expect this area to act as resistance. And we also have local levels, which are small areas within structure. We will be going through. This is a nuance, very important, very good, powerful for intraday trading conditions. And support and resistance are also excellent for locating trades, as many bullish setups occur at support, and many bearish setups occur at resistance. We know we may have a spring or an up thrust. They're also good for targets. If we buy down here, okay, and we expect prices to go up, the resistance would be our target, our first target that we need to overcome. And then obviously if we look to the left, we need to see if the core's built to see if we can break through and then go on to the next level, our next level of resistance. Okay, so before we begin our first study, let's just do a mild recap. Okay, support and resistance is the most widely used aspect of structure throughout the world. Whole methodologies have been constructed around this phenomenon and play a key part in day-to-day trading. There are support and resistance traders across all time frames. They exclusively trade support and resistance strategies. Now, these are not complicated. They merely buy support and they sell at resistance. Okay, that is their model. Now, drawing support and resistance does require an artistic license. Although support and resistance is more definitive, definitely less ambiguous compared to the construction of trend channels. They may need adjusting 2, 3 or 4 times. This is not the case with support and resistance. However, there are subtleties that may require more of an artistic license, which we will discover shortly. As previously stated, we can use support and resistance for setups. You may be wondering why. Well, think of structure or support and resistance. It has our back. It props us up. We can lean against it. Think of it like an elastic band. So as price comes down, it kind of, it's not an exact level. It's kind of bouncy. It kind of holds. It contains price. We have previously discussed support and resistance for targets and also the sentiment. If price is unable to test a previous level of support and resistance, we gain additional information. Example, say we're at a support level and we hold a slightly higher level of support or local level. This gives additional signs of strength. Okay. Later on in the sessions, we will discuss the approach to support and resistance and how price interacts at support and resistance. We're looking for breaks. We're looking to see how price reacts at resistance. How strong is the resistance, and we can do that by gauging the pullbacks. After all, the very nature of support and resistance is that demand should emerge at support and supply, selling, should emerge at resistance. Now, this is very, very important. Try to keep this in the forefront of our minds. Okay? Demand should emerge at support. Supply should emerge at resistance. Okay? And if we break decisively with decent price action, either support is now resistance and resistance is now support. Let's begin our first study.